Okay, so next we want to talk about first part of Chapter 11, Property Dispositions. So we'll go to top of page 9 here, so just not very long. Not going to talk about depreciation recapture. We just don't have time to cover everything in a 10-week course, so some things have to go by the wayside. All right, so we've already talked about this somewhat, but expanding on the idea of the amount a taxpayer realizes from the sale or other disposition of an asset. So as it notes, it's everything of value received from the buyer less any selling costs. This includes cash, other property, the fair market value of other property, as well as any assumption by the buyer of any liability tied to the asset. So why is that last one in there? Well, if the buyer is relieving the seller of a liability, it's as if the buyer in this transaction gave money in the amount of the debt that they assume equal to the amount of money or amount of debt that they are assuming. So they gave, think of it as giving that money to the seller, and the seller turning around and paying that money to the creditor, the party holding the debt, to get rid of the debt, to be absolved of the debt. So that's why any liability assumed by the buyer is added to the amount realized. So, but, and again, what is a disposition? Well, a disposition can be a sale, but it can be other things. So it says, no matter how it is accomplished, every asset disposition triggers a realization event for tax purposes. So you dispose of property in some way, you give it away, you simply, it's not worth selling because nobody wants it. It's a obsolete technology, so it would cost you more to dispose of it than you would get. So you just chunk it. Well, you're going to have a loss, but it's something that has to be done. You're not realizing an amount, but disposition goes beyond. My point is, a disposition goes beyond simply a sale. Why is it important mainly when there's a sale? Well, because there you're actually receiving something in return. Usually cash, but any type of property will do. What if the buyer provides services? Well, the fair market value of the services has to be included in the amount realized. So again, as we looked, the amount realized minus the basis or adjusted basis of the property is the gain or loss on the disposition, or the gain or loss realized. So adjusted basis is the initial basis if it's depreciable property. Then you're going to take the initial basis and reduce it by any depreciation up to the time of the disposition. So initial basis minus any cost recovery equals the adjusted basis of that asset. So as I pointed out, the gain or loss realized equals the amount realized minus the adjusted basis. So look at those formulas in Exhibit 11-1 on page 6. Gives a good summary. The example in Exhibit 11-2 as well is a good summary. So, and notice in Exhibit 11-2 it talks about the total gain realized. Now some of the property had a gain, separate property, individual properties had a gain, but one actually had a loss realized. But total for the year is overall a gain realized. So gain or loss realized and there's your example in 11-2. So you've got your amount realized in column 1. You've got your initial basis. You've got your depreciation, your cost recovery up to the time of the disposition of each property. The difference is the adjusted basis of each property. And of course, the amount realized minus the adjusted basis is going to be the gain or loss realized on each asset. Now, as a general rule, if gain or loss is realized during the year, they must recognize that gain or loss. And these recognized gains or losses either increase or decrease taxpayers' gross income. And so they must report recognized gains and losses on their returns. Sometimes, if Congress deems it appropriate, they will uh, allow for legislative grace to um, allow a taxpayer to exclude certain gains, mainly gains, not losses. Now, let's talk about adjusted basis, because that can get kind of tricky depending on how you obtained the property at issue here, the property subject to the disposition. You could receive it, most of the times you're going to receive it by purchasing the property. And again, when I say property, any type of property, personal property, such as, and again, we're talking for the most part here, business property, but investment property, stocks, bonds, things like that could be included here as well. Personal use property. But anyway, back to my point, property that is subject to disposition could be obtained mainly through purchase, but they could also be obtained by gift, or they could be obtained by inheritance. And so, again, if it's purchased, your initial basis is the cost plus any cost to get it to its location, plus any cost to get it into its intended use. For gifts, and definition of a gift, I'll let you read that. Um, if the fair market value of the asset on the date of the gift is greater than the donor's basis, then the initial basis is the same as the donor's basis. So it's carryover. Well, what happens if the fair market value of the asset being gifted is less than the donor's basis? Well, in that case, what you have is a dual basis. And you don't know which one you're going to be able to use until you actually dispose of the asset. So you have a one basis if it's sold for a gain, and another basis if it's sold for a loss. And so the donee, the one who receives the gift, uses the carryover basis if the asset's sold for a gain. If it's sold, well, if they sell it for a loss, meaning sales price is less than the fair market value at the date of the gift, then they would use the lower fair market value at the date of the gift. So dual basis. So that's kind of difficult, but you can figure it out. For inheritance, much easier. Inheritance, the person receiving the inheritance, the inherited property, gets to use as their basis in that property the fair market value of the property on the date they receive it. So that's good. Not only that, back to gifted property. As far as the holding period, because that's kind of important to know. When the dual basis rules apply, meaning the fair market value of the assets lower than the donor's basis at the time of the gift, when dual basis rules apply, the donee's holding period depends on whether the gift property is sold for a gain or a loss later on. If the donor's basis is used to determine the gain, meaning sold for a gain, the holding period includes that of the donor. So you have a carryover basis. If the fair market value at the date of the gift is used to figure out the loss, the holding period starts the date of the gift. So bottom line is you may have an issue with long-term, short-term capital gains depending on whether or not you have a gain or a loss. You might turn a capital gain into ordinary income if you sell it too soon. Well, that's not true. Actually, what would happen is if you sold it too soon, you have you use the holding period at the start of the date of the gift if you are using fair market value to determine a loss. So the only time you're going to have a situation where holding period's not very long is when there's a loss. And so basically what would happen is you would be turning possibly a long-term capital loss into a short-term capital loss. Not a big distinction, because as long as it's capital loss property, you get to take $3,000 of that capital loss and apply it to other income, reducing your taxable income by $3,000, or at least your taxable income by $3,000. Back to inherited property. So anyway, when the recipient of the inheritance receives this property, they get to include as their basis in that property the fair market value of the property on the date they receive the property. As far as the holding period is concerned, it's considered a long-term holding period, regardless of when they dispose of the property. And so they can receive the property and dispose of it within a year or less and still consider that long term. Now note, you can use an alternative valuation date of 6 months after the date of death to determine fair market value, to determine the basis in the property. What happens when you are using property for personal use, such as a vehicle, a truck that you own, that you turn into some sort of work truck for a new business? Well, here the basis depends on whether or not the property is appreciated, or as many often times happens, declines in value during the time the property is used personally. If the value of the property has appreciated, the fair market value is greater than the taxpayer's basis at the time of the conversion, then the taxpayer uses its basis, the cost of the property at the time of the disposition, in determining gain or loss. If the property has gone down in value during its personal use, then guess what? You have a dual basis. And this is going to sound familiar. If the fair market value at the time of the date of conversion is below the taxpayer's basis, the taxpayer will use the fair market value at the date of conversion as the basis for calculating loss, and will use the basis at the date of conversion to calculate gain. Note here that the fair market value at the date of conversion is also the basis used to calculate depreciation on the property if it has declined in value. And that's true regardless of whether the taxpayer subsequently sells the property for a gain or loss. And so I would encourage you to look at examples 11-2 and 11-3 and 11-4 for examples. Now let's talk about the character of the gain or loss. And here's an example before we get to that. Scrappy Happy owns a computer, 5-year Macker's recovery period. When it was purchased 2 years ago for $1,200. For financial statement purposes, the computer depreciates over 3 years using half-year convention and straight line method with no salvage value. What is the adjusted book and tax bases for the computer after 2 years of depreciation? Well, for book purposes, doesn't really tell you what the useful life is, but you would assume 5 years also. You know, the useful life for book purposes is not always the same as what Macker's is. Many times it's shorter, Macker's is, than the useful life for book purposes. So they didn't really explain that here, that's also the useful life for book purposes, depreciation. So anyway, that's why it's a little confusing. So anyway, book, straight line here, you just 200 a month, or excuse me, 200 a year. So every year 200, after 2 years, 400 accumulated depreciation. See what they're doing here. Yeah, I don't know. This is a lousy example because they don't give you enough information about why they're depreciating 200 in that first year and 400 in the second year, except I guess maybe they purchased it mid-year. So anyway, not a good example. All right, so let's try this. They sell the computer in the previous example. The adjusted basis at the time of the sale is, tax basis is $576. They sell it for $400. Well, easily the amount realized, 400 minus the adjusted basis of 576, equals a $176 loss. Not much of an example, in my opinion. All right, so if you have to recognize a gain or loss on disposition, next thing you have to consider is the character of the gain or loss. And so in order to determine how a recognized gain or loss affects the taxpayer's income tax liability, they must determine the character or type of gain or loss recognized. Ultimately, every gain or loss is characterized as either ordinary or capital. Now, for businesses may recognize certain gains or losses on property dispositions that require some intermediary steps, but these 1231 losses are taxed as either ordinary or capital. So, property used in business has to be determined whether or not it's ordinary or capital. So you've got these 1231 losses if it's property used in business, and then you determine whether or not it's ordinary or capital. So why is it important to determine the character of the gain or loss? Well, because different characters are treated differently for tax purposes. Ordinary income or loss is taxed at ordinary rates. If it's if it's ordinary income. If it's an ordinary loss, it's taxed, it's fully deductible against ordinary income. Capital gains are taxed at lower rates, preferential rates. Deductions for capital losses are subject to certain restrictions. And so the character of the assets that the taxpayer is selling is what determines the character of the gains or losses that the taxpayers recognize when they sell assets. Well, how do you determine the character of an asset? Well, it depends on how the taxpayer used the asset and for how long the taxpayer owned the asset before selling it. So property can be used in a trade or business. It could be treated as inventory or accounts receivable of business. It can be held for investment purposes, or, as we've discovered, can be used for personal purposes. And so that determines how it's used. That asset's used determines the asset's character. The asset's character determines the character of the gain or loss. So look at this exhibit here, 11-3. Okay, so you've got a holding period there in the first column, short term or long term, short term 1 year or less, long term more than 1 year. If the property use is in a trade or business, and they are ordinary assets, they're taxed as ordinary income. Well, what's an ordinary asset? It's inventory of the business. Well, why is inventory of a business taxed at ordinary rates? Well, I mean, that's the reason why the business exists. Notice that that doesn't include in their service businesses, because service businesses don't have inventory. Well, the service businesses do not get away from this because ordinary assets also include accounts receivable. So accounts receivable is what occurs when you sell a customer on credit for products or services you provide them. So both those things are taxed at ordinary income, ordinary rates. Next, well, let's go to long term. Property used in a trade or business. Now, this is the great thing about property that you use in a trade or business. It's the best of both worlds. If you sell a long-term property used in a trade or business, you have either a 1231 gain or a 1231 loss. Well, why is it the best of both worlds? Well, if you sell it at a gain, then it's treated as a capital gain. It's taxed at a capital gain at either 0, 15, or 20%, depending on the taxpayer's income, other income. Well, what happens better than that, or as good as that? What if they sell at a loss, 1231 property? Well, here it's really good because if you sell 1231 property at a loss, you get to realize the whole loss in the year of disposition. Okay, so you're not limited like you are with other capital losses to simply offsetting $3,000 of that loss in the year of sale and going forward with it to future years and offsetting future years ordinary income. Best of both worlds. back to ordinary assets. What if you purchase a an asset that's not inventory, it's not receivables, it's a piece of machinery or something else that you use in your business, but you sell it within a year, 1 year or less. Well, that's treated as an ordinary asset also, and any gain on that sale would be ordinary income. Now, the good thing is, if you sold it at a loss, you would deduct the loss against other income also, just like you would if it was a long-term asset. The problem is if you sell it for a gain, gotta list it as ordinary income. But if you hold it for more than 1 year and sell it for a gain, it's treated as a capital gain. Regardless if it's used in business, whether you hold it 1 year or less or more than 1 year, you sell it for a loss, you get to deduct the whole loss against other ordinary income. Moving on to investment assets. And again, we'll look at this in a second. What's a 1231 asset? We'll look at that in a second. Let's go to capital asset. And again, capital assets can be for investment purposes. They can be for personal use. And as you already know, if it's a capital asset and it's used for investment purposes, you get to, and if you have a gain on the disposition, you get to use preferential tax rates, capital gains, if you hold it for more than 1 year. If you use it for investment purposes and you hold it 1 year or less, you're going to be taxed at ordinary rates. Personal use assets. You sell personal use assets for a gain, depends on how long you hold the asset. If you hold it 1 year or less, it's taxed at ordinary rates. If you hold it more than 1 year, it's taxed at capital gain rates. And as you probably recall, if you sell personal use property for a loss, you don't get to use any of that loss as a capital loss. It doesn't get put into the equation. All right, so what's a 1231 asset? 1231 assets are depreciable assets and land used in a trade or business that are held for more than 1 year. So again, if the taxpayer recognizes a net 1231 gain, the net gain is treated as a long-term capital gain. If the taxpayer recognizes a 1231 loss, the net loss is treated as an ordinary loss. Now understand, even though we're not going to talk about it, certain 1231 gains on individual depreciable assets may be recharacterized as ordinary income under what's called the depreciation recapture rules. Okay, so these depreciation recapture rules apply to depreciable assets. They don't apply to land. And so land is what's called a pure 1231 asset. As long as you hold it for more than 1 year, it's going to be a 1231 asset and not subject to depreciation recapture if it's land. All right, so that's pretty much it for chapter 11. We move on to talk about fringe benefits in chapter 12, a very short chapter. And then after that, we talk about the sale of principal residence, chapter 14.